welcome to Wednesdays with iGTB. This is Intellect Design Arena's regular webinar series focused on transaction banking. My name is Joshua Cohn and I lead the liquidity management business at Intellect. And today, our lens is firmly on liquidity management, and in particular, how through client-provider partnerships, corporates and banks can achieve a symbiotic relationship, a win-win. We have over 500 registered attendees. We have lots of data to share, and we have a top-notch panel. So let me just introduce the panel very quickly. I'm joined online by Dr. Tobias Miarka, the co-head of banking at Coalition Greenwich, by Philippe Sass, a vice president at Unilever and the corporate treasurer, and by Philippe Penichou, managing director at Société Générale and head of international payments and cash management, and a bank which has recently announced its partnership with Intellect for liquidity management. The agenda for the webinar starts with Dr. Tobias Miarka, who's going to be opening the hood on the results of a recent Coalition Greenwich survey of corporate treasurers on liquidity management. And that'll be followed by, well, a couple of seconds from me just describing some trending themes that we're seeing for liquidity management solutions. And then a panel session between Philippe, Tobias and myself. And of course, at the end of this, we'll look to address any questions from the audience that you want to put through on the chat function on this webinar. So without further ado, I'm going to pass over, if I can please, to Tobias, who's going to take us through the survey from Coalition Greenwich.
Thank you very much, Joshua, and thanks everyone for joining. So what we want to start with is sharing some of the data we've been able to gather by interviewing many hundreds large corporates across Western Europe, but also by benchmarking some of the actual digital capabilities of banks we're working with. And maybe to set the scene a little bit, I think it's now very clear for everyone that digital transformation will determine the future of competitiveness, both in terms of the buy side as well as the sell side of bank-firm relationships. So bank-firm relationships really increasing depending on technology and data. And we've seen also that the banks and the corporate management teams are beginning to really embrace the next-gen reality. So actually, if you look back, it was kind of an evolution of the need being seen by the technology departments of banks and other parts of other departments, disseminating upwards to the C-suite. Digital capabilities became a very hot, and is still a very hot topic at the C-suite level of banks. And then it's now disseminating downwards again to be implemented in the different actual capabilities. And I think the same is true, and Philippe Sass will tell us, I'm sure later on, that the similar experience is seen on the corporate side. So this is both on the corporate and on the banking side. Now, what we do see is obviously that banks that are underinvesting are really risking now to being leapfrogged. We've seen similar experiences in other industries like the automotive industry. If you're reading the FT this morning, again, Foxconn, the supplier of Apple, now thinking about going into the automotive industry. I think it just shows the magnitude of disruption and change that we are facing, and banking and bank-firm relationships is a big part of that. So the key questions that leadership teams of banks and corporates alike are asking themselves: is my pacing of investment on par with peers? Where are the largest capability gaps? Are there actually opportunities to co-develop, which I think is also an interesting discussion later on. I'm sure we will be entering. Are investments delivering the required experience and cost efficiencies, especially during COVID now, cost efficiencies being even more of an important point? And how do I prioritize? And that's probably the hardest questions for leadership teams to answer how do I prioritize investment spend to remain competitive. And again, this is not just a question on the banking side, but just equally on the corporate side. Now, having talked to large corporates multiple times during the last 18 months, I just want to share with you some kind of the experiences that were reflected back to us. We've seen that in the first lockdown, which is now more than a year ago, there was an initial shock where the vast majority of banks, of corporates, reported to us that they were impacted negatively or severely negatively due to COVID. And the most valuable response they received from banks was operational support. The focus, the most immediate focus was on securing liquidity and basically keeping afloat. We've seen that there was an evolution, and so in the second lockdown, people moved, majority of corporates moved from an initial shock phase to the react or respond phase, but still 60% of corporates reported that there was a negative impact on their business due to COVID. The valuable bank responses, and I have to say in general, banks were much more seen as partners in this whole process than not, but it shifted more to process efficiencies, and with it also the digital capabilities. And the corporate focus shifted from securing liquidity in the first place to client experience more broadly in the bank firm relationship and the broader sense of liquidity management. So which brings us obviously to the focus of today's session. Now, we also asked what are the most valuable responses, as I mentioned, and as you can see here again, providing more flexibility for documentation, provide necessary support to adopt digital processes was absolutely striking a kind of number one and number two responses. And I think, everyone realized that very easy, seemingly easy things like a digital or like e-signature exception was something that really helped to keep a smooth operation while the workforce was starting to work from home. Now, when looking at who are the winners and the losers so far, I think this is quite an interesting slide in the sense that we see that global banks had quite an improvement in terms of clients mentioning them for getting more business. And local banks and regional banks were more struggling. And the reason behind that was that high on the list of capabilities were two areas. One was a strong digital liquidity management solution and strong digital capabilities as such. And we have to say that global banks have been spending a lot of effort and money and capabilities into this already pre-crisis. And the other element was actually also the international capabilities that they bring, because COVID also triggered a lot of kind of rethinking about some of the cross-border needs that corporates have. I have to say at the same time that we don't think regional banks or local banks should be pessimistic. There is still a lot of chance to catch up, and we've seen also some examples of local and regional banks doing so. But at the same time, you can see that with this real shift, so this is real client relationships moving from one bank to another, there is an urgency to catch up. And I can tell you that also, even the leaders who have been improving here have not been standing still. So the innovation will definitely move forward. Now, the changes in the top business priorities were really accelerating during COVID. And this is really an astonishing kind of finding. If you would ask a similar questions, the question being, are you changing are you changing any of your business priorities in let's say more normal years? About 15–20% of corporates would say yes, in the next 6 to 12 months we're probably going to change our business priorities. But when we asked this question at the second half of last year, 55% of corporates were really saying that they're going to change business priorities. So this is definitely a big shift. It derails kind of the business as usual kind of attitude, and also the change is also the attitude that change is no longer driven by incremental small steps over an extended period of time, but real significant changes. Now, when we then asked and looked into more verbatim of what are the top business priorities that people are moving to, an astonishing number mentioned that liquidity management, including financing and processes, was really top of the list, that weren't really maybe a top business priority in the past, but now has really emerged as super important. So really quite a lot of shift and a lot of movement. Now, looking more broadly into the development of innovative solutions for cash management, we find that there are at least kind of 4 big areas. And the first one, coming back again to our theme of today, which is kind of liquidity management. So payments, receivables, real-time tracking of international payments and receivables, reconciliation becoming simpler. We also see an increased openness and a strong innovation in the areas of APIs. So application programming interfaces and other emerging technologies really accelerating some of the capabilities. For example, it allows to diversify from incumbent liquidity management banks in specific markets and really goes and do this seamless with API integration. Obviously, also as COVID was kicking off, a lot of rethinking about the supply chain. We see a lot of innovation here as well on the digital side. And last not least, big theme always also is risk mitigation solutions. I would be curious to hear later on, also see some reaction already from the panelists, that what you can bring to kind of more examples around these areas, because I think that's really where a lot of innovation has been seen. Now, a little bit more specific on application programming interfaces. 55% of corporates we interviewed said that they are ready to accept APIs. So this is a big change, and that also is an invitation of the providers to really now have the recipient ready to embrace those capabilities. And they touch a range of areas, including liquidity management, but again, also financing, credit processes, internal accounting, real-time payment, and also, as I said earlier, risk management being a very important party as well. Now, I think when talking about innovation, it's interesting that while there are only 1 out of 5 companies have experienced new values from predictive analytics, nearly a third would actually allocate more business to providers with such capabilities. So now we are entering into not just talking about improving processes or automating existing processes, but also going 1 step beyond, which is also part of obviously liquidity management, to actually have predictive analytics enhance the overall experience. And again, I think for the banks that are listening, I think it's an important takeaway that there is real business in this, because while, and clients are open to receive more of those innovations and are moving and are willing to move business towards providers that can provide this type of innovation. So a lot of openness and eagerness to embrace change and be ahead of the curve if possible. So I think that brings us to kind of look at the evolution a little bit more. So we see a lot of banks obviously trying to address the actual pain points with digital capabilities around things like fraud detection, onboarding, etc. So this would be still the kind of the first level of improving processes, but increasingly clients are expecting to have more in store and have also their actual needs be better served for via digital capabilities. And again, the readiness is significantly has been increasing over COVID. So tools and technology to improve on the actual meet the needs of clients. And then we see some very small level of leaders that will go one level even beyond that. And that we call internally at Greenwich Coalition client delight. So new client values, creating new values around, for example, highly tailored predictive analytics and prescriptive recommendations, because people don't want kind of platitudes and kind of preset kind of slides that address a range of let's say more shallow or address more shallow points, but they want truly tailor-made solution, and these can be done more and more also by using the predictive analytics, for example, that we've touched upon earlier. So breaking it down again to the liquidity management theme, we see a few emerging factors here. A lot of banks are focusing on improving the breadth, the integration and consumability of their liquidity management offering, touching upon cyber and fraud mitigation, being embedded in workflows, and then obviously the integration, so the connection across available investment products, the integration with banks' separate systems and data sets, and then integration with client systems. Now, the next level, which we in the previous slide mentioned as kind of client delight, is really creating new client values. So this would be focusing more on data management, have a strong foundation with clean, normalized, and well-governed data, which again comes also back to maybe the core development of some of those solutions, because that has to be done jointly. And then come to this next generation capabilities to provide new client values. And last not least, and this is a takeaway probably for the banks listening, don't just focus on the actual capabilities, but make sure that whatever you do is also known to your clients and prospects. So driving awareness and driving the robust adoption of new capability is key. We've seen some banks really doing a lot, but then not getting the uplift as much as they anticipated, because clients might not always be aware. And that is obviously also underpinned by strong marketing of the innovation and to really make sure that communication around those capabilities is clear. And if you do a lot of co-development, that will be even easier to navigate. And I would like to finish this type of sharing of some of the data points by highlighting that the digitization of corporate liquidity management functionalities is still at a very early stage. So this data that I show here is based on Greenwich benchmarking the actual capabilities of different banks going through about 50 major factors that we benchmark. And you can see here that there's only 4% of those important factors where we see they are actually commonly available. There's a vast majority of 59% of capabilities where you can see already that it really is a competitive differentiator. And then there are a few best in breed capabilities, 15% of those, which are really only found in very few offerings at this point. So you can see the big range, and that the majority of corporate of banks are really still at the basic level, and there's a huge importance opportunity to differentiate. And as we've seen with the client feedback, that clients are ready and expecting more and more, I think this will just highlight how important it is to accelerate making some of these capabilities more prevalent and more available again. So let me stop here and hand it over again to Joshua, because he wants to just share a few points on what they have been seeing also lately on how clients are, corporate banks are investing in these capabilities.
Thank you, Toby, and no, very insightful, and there's an awful lot to digest there. The one takeaway that I had, which is a bit like my annual school report, is we could do better. And that opportunity that you just mentioned, the opportunity for improvement, that you know is very clear. So the slides I'm just going to very quickly talk to. The first slide that we have is a summary of what we are seeing in the RFPs and RFIs that we receive from banks across the globe. The overarching theme here is how global the trend is to deliver ever more sophisticated liquidity management solutions. Let me explain the graphics here. So each different colored dot represents a bank. So for instance, there may be a light brown dot, there may be a dark blue dot. That's one bank. And that's one bank which has sent an RFP or RFI. So they're really on the journey to improve or upgrade their liquidity management capabilities. Now, each individual dot is itself a country where that bank is looking to implement liquidity management. So this is about the last 24 months of data that we have at Intellect. And it covers around 20 different banks that were issuing RFPs in that time period, some of which have gone on beyond just simply issuing an RFP and followed by an RFP. Followed by actually picking a vendor. Now, I think what it shows is that banks globally are acutely aware of their clients' liquidity management needs and are therefore trying to upgrade and provide to those needs. So the next slide shows the trending themes that we're seeing. In other words, what are those needs that are over and above, for instance, zero balance end of day sweeps? And you can see some themes here that develop. If perhaps we then flip to the following slide, we're mapping global versus just what we're seeing in Europe, for instance. So some differentiators between what the global banks or banks globally are requiring versus what's needed in Europe. And you can see negative interest rates, the availability to show different investment opportunities is quite clear, more so in Europe than perhaps everywhere else on the world. And this then talks to this sort of win-win theme that we have. The idea that if a bank can deliver better quality capabilities for low interest rate scenarios, investments in particular, then the bank can gain from better servicing of clients, and the clients gain from having better reward for their cash. The same for, of course, dynamic pricing, the ability to automatically adjust pricing based on the client behavior that they witness. So they're the two slides I wanted to take. I think now perhaps if we can move back to the panel who've kindly been sitting quietly waiting for their moment. And one of the earlier slides I saw, there was a reference to perhaps 18 months, that there's this 18-month window to do something about this gap that's evident, that everyone can do a little bit better. So in terms of 18 months, how will underinvestment manifest itself? What do we think about that? And perhaps, if I can ask Philippe, if you could explain, you've gone to the market to improve your liquidity management capability. What does underinvestment mean perhaps for your competitors?
Well, any underinvestment will manifest itself pretty simply. You're out. And yes, some banks may have invested a little bit less than others due to two main factors in the recent past. So two main factors. The number one factor, obviously, is the skyrocketing cost for running a bank those days, with more regulatory pressure and negative interest rates in Europe in particular. So that's factor number one. Factor number two, it's clearly the pandemic situation and the subsequent economic crisis. So because of that, clearly many banks have been investing a little bit less. And if you combine these headwinds with the new competitions coming from a bunch of new players in the financial sector, the so-called fintechs, you end up with a very, very challenging environment for the banks, where only the stronger and the more serious about cash management will survive. So in a nutshell, less banks will be playing in the Premier League of cash management in the future because less banks are having the capacity to cope with the investment needed to be meaningful in cash management. But I can tell you that, and you know that obviously, is that when it comes to Société Générale, we're investing more than ever than we ever did in cash management, which proves how serious we are about this business.
Thanks, Philippe. And Philip, I'm just looking enviously at the ice cream behind you. So soon the summer's going to be here. But how much time do your bankers have? I mean, in terms of ensuring that they have the right capabilities to support you as a
thanks, Joshua, and thanks Tobias. It was a very relevant presentation. A lot of the things you are putting out there actually resonates with kind of me sitting in a corporate and then dealing with our kind of key relationship banks, call it kind of 20 big international banks that we're dealing with on a regular basis. Now, I wouldn't get too paranoid on 12 months or 18 months. I think the spirit here is that of kind of continuous improvement. So what you just said in terms of it can always be better than it is. And I think with all the innovation and technology around, I think the big prize is how can you leverage the data that we have more efficiently? How can we gain insights? How can we apply, I think you mentioned it, kind of predictive analytics on the data set that we have. And when you operate in 190 countries, then you don't want to be dealing with 190 banks in 190 countries, ideally, and then try and bring that all together to drive some insights. So I think my message to our bank partners, and for me, it's a partnership, it's a relationship. It's not something you change every day, frankly, because it's quite complicated, with a big, certainly in the consumer goods sector. And sorry for putting up the Magnum, maybe someone will buy one afterwards. So I've achieved a little side benefit here for the company. It's important to stay innovative and to be able to talk, because we're not changing the landscape every single day. And I know the banks that have the business are always happy, and the banks that don't have the business are unhappy. And the question is, how can we become more competitive and get that business? And I've noticed on the participant list, there are some of our bankers. So hello, guys, nice to see you here, and everybody else. I think it's consistently investing and working on capability, and we do recognize improving capabilities, and there's no denying that technology and innovation are really important. I mean, we've been doing everything from home for the last 15 plus months, and it's working. You know, who would have thought? So it's critical to invest, and then also think about where can you differentiate, because if I look at the other side of the coin, you know, you as a bank, you want to gain business from your client. Me as a client, I'm looking at the banking landscape, and I'm having to make a choice, you know, how to select the one that we want to work with, and what are the criteria. I think we'll come to that, but you know, you also have to look at both sides of that same coin.
Can you perhaps expand a little bit on that? You know, what are those criteria that you,
sure.
you judge your banks by?
Yeah, sure. So I guess some of the traditional aspects you would be all familiar with, in terms of what's the capability in a particular geography, the ability to kind of process payments, collection types, all of those things that are kind of important. It's also about, can the bank support a cash pool setup, because we like to centralize as much as we can into our in-house bank. So what's the ability of a partner to support cash pools? It's also competitive pricing, but it's probably not the dominant factor. It is relevant, but it's not the dominant factor. It's also about implementation. How easy is it to implement, and what is the support and service level that we receive? Often that only crystallizes once you're on the journey together. But I can tell you, it's quite important. You know, if I get a phone call from someone on this planet saying, "Oh, by the way, we're having all these queries and issues, and bank A, B, or C is not responding. Can you please help?" So the ability to solve issues together quickly is very important to us as well. So this is what I would call probably the traditional stuff, let's say. But increasingly, it's about technology and innovation. You know, it's about, can we implement virtual accounts? Can we do payment on behalf, collections on behalf? How easy is it to integrate APIs? You know, how difficult are the interfaces? Is there a willingness to be a strategic partner? You know, how can you leverage data insights that you have together and drive kind of impact for the business? You know, because, you know, Treasury, in a way, we're also a cost center to the business, but we're not the biggest cost center of Unilever. So sometimes people can forget. So it's important to be sharp, but it's not about optimizing the last penny of fees. It's about getting the right insight to drive the right action and to get better every day, to get the efficiencies. So that's increasingly kind of moving to the forefront. And I think ESG components are also becoming more relevant. So environmental, social, governance, these aspects are very important. You know, part of liquidity management for us is also short-term investments. And we've been kind of working with a lot of our key bank partners to pioneer green deposits, ESG deposits, when we have surplus cash, that we can place it where it has an additional impact or benefit. So, you know, on the less traditional front, it's about technology, innovation, collaboration, and willingness to have that dialogue together. Because, you know, my observation is, when you mandate such business, you're in it for some time. As I said, we don't change it every year. But of course, from time to time, we do review how competitive is the setup and what else should we be doing, and can we innovate within existing structures. And I think to Philippe's point, I think this is where we do notice where certain banks make a lot of effort and investment to become more future fit, future proof, easier to work with. That obviously doesn't go unnoticed to us either.
So part of that journey, that future proofing, is about the technology, and Tobias in his summary just before showed in particular, he referenced the APIs, the application programming interfaces, and Philippe, you just mentioned it as well. So Philippe, how prepared is the banking industry to deliver these APIs, or to be able to access APIs that will enable this sort of win-win, this symbiotic relationship to be fostered?
Well, to start with, I like to say that first, banks have seen APIs, you could say the fintechs, as a threat. Well, personally, I've rather seen both API and the fintechs as a great incentive to do more, better, faster. A great kick to the banking sector, if I may say. And the result is already out there. Look, I have been in this business, in the cash management business, for more than 20 years. And how many breakthrough initiatives have we seen between 2001, when the first web-based banking platform were launched, and 2018, 2019 maybe? Well, not that many, I'm afraid. And here we go today with API, Swift GPI, instant payment, request to pay tomorrow, artificial intelligence everywhere, robotic automated process, RAP, I guess that's the acronym, everywhere too. So clearly, it's a fast-moving environment, and bank must develop their agility. Real-time instant payment are no longer are not an option today. So are the APIs. APIs are not an option for us today. However, what I'm hearing from large corporates is that they don't want to be dealing with numerous API formats, for the same service, which is most probably the case today. If you take most of the large corporates, they have 10, 15, sometimes even 20 banks. If they go to, let's say, 5 banks and 3 vendors, they will most probably, for the same type of service for an API, they will most probably end up with 8 different APIs. So some kind of harmonization, alignment is expected, I guess, from all the actors, banks, fintechs, vendors, Swift itself, etc. But at the end, as I said, API is not an option, and it was a good kick to the banking sector. So I'm glad we are where we are today.
Mm-hmm. Yeah, thanks for that. Yeah, there's a lot of acronyms creeping into the industry that we didn't have a couple of years ago. Although I must say, APIs I think have been around for a long time. Toby, one of the things that you mentioned was that about a third of corporates, and correct me if I got this wrong, but about a third of corporates are willing to allocate budget or investment to get specific solutions delivered that are tailored to their needs. So that's a third now. You anticipate that that's going to increase or stay flat, or is this a trend that we're seeing, or is this?
Yes, I mean there are two things to this. I think the first one is that, as you've seen, only 15% actually have experienced improvements, but double of that are actually willing to allocate new business. So they're giving a little bit the benefit of the doubt to those who are willing to innovate. I think that's the first takeaway. So, I mean, there's a huge openness to allocate more business to those who are innovating and are, as Philip said, keep on pushing and improving. So that's the number one. I think the other takeaway we've seen when talking to corporates is that while price is still the number one differentiator, there are now more corporates willing to pay a little bit more, knowing that they might get something much more stable and something more innovative. So it's payment can be actual fees or providing or allocating more business. There are different ways of paying your banking partner. But I do think that the data clearly shows the innovation is paying off. But then again, it's about making the right priorities, and that's why the dialogue between corporates and banks are so important to innovate in those areas where the recipient sees a real value. Because on the other hand, we've seen the clients say, well, digitization doesn't necessarily mean things making things easier. Sometimes digitization is just a cost measure from the banks, but it doesn't help to be more efficient on the corporate side. So to keep that balance is also important.
Yeah. So I'm conscious of time, keeping an eye on the clock. Perhaps if I can just throw a general question to the three of you, please, and then we'll probably go to some of the questions that are coming from the audience. But this is a question that we had ourselves, which was post-COVID and in the age of fintechs, where do you see the biggest win-win coming from to help build this sort of symbiotic relationship where both bank and clients are getting an improvement in things that can deliver on the bottom line?
Yeah, I think Philippe referred to something that's quite important, which is kind of the ability to pool the approach wherever possible, you know, because when you're dealing with a setup, let's say, of 10 banks, and everyone has their own proprietary way of doing things, and also see in the Q&A some questions coming along the lines of, you know, what channels of communication do you use? Is everything concentrated in your treasury management system, or do you have bank-specific ways to communicate and interact and get access to information? And I think today it's all of the above. You know, we use any and all available channel that is necessary to get work done. But obviously, from a selfish corporate perspective, the more aligned the way of communication becomes, the easier it is for me, the more effort I have to put into establishing bank-specific solutions that might be leading edge, but I'll be having to deal with 10 different versions of them. So the ability to interface is really critical. So I think a big part of the win-win is how do we find the easiest way to interface and collaborate effectively. And then I guess the other main area for me is how can we leverage the data? You know, there's this lake of data out there that is sitting there, and how can we drive value from that? Not just the visibility, but also the insights. You know, if you see certain flows in certain currencies at certain recurring times, how can you anticipate certain actions? How can you become more efficient in the way you deal with different flows? So I think that's probably where the biggest win-win is from my perspective, because, and I know it's a pretty tough message, you know, for me as a corporate client to talk to our banks and say, hey, give me a platform approach. You know, I want something that's bank agnostic, because, you know, of course you don't care about your competitor, right? And I don't care about my competitors either. So I know what it feels like. Yet we are faced with this challenge of how can we build the most efficient way to interact and leverage the data that is out there. So I think that will really be a big unlock.
Mm-hmm. Yeah, data is a big thing, and I think we're all grappling with how we can represent it back out of, as you say, these great big data lakes. Sorry, Philippe, how do you feel? Where's your biggest win-win coming?
Well, you know, talking about this symbiosis between fintechs and banks, for me, it's totally natural. You know, on one side, you have fintechs, which brings agility, innovation, time to market solutions. And on the other side, you have the banks, which brings, I believe, security and reliability, and two important matters when it comes to keeping your cash. And again, the natural symbiosis here, because clearly fintechs will, well, most of them won't want to bear the burden that all banks are bearing today on the regulatory side. And at the same time, the banks are never going to be as agile as the fintech sector. So symbiosis is totally natural, and this is the way forward for me. This is how banks can invest, maybe have to invest maybe less on certain products, so they can invest on more products, and be a lot quicker at developing the solutions that our clients are expecting from us. So yeah, that's my win-win. We won't survive without the fintechs, and the fintechs, I believe, still need the banks for bringing, as I said, this reliability, security, long time history about dealing with money, financing the clients.
And then Philippe, if I may build on that, I totally agree, by the way, because there are, and you are right, you know, we want scalability and safety, but we also want innovation. So the answer is in the combination of both, because equally, you know, as a corporate treasury team, kind of we're a small centralized team, So our ability to interact with many less organized or formalized startup fintech companies, there's also a limit to our ability to do that. So how do we capture both of that? And you're right, we're also using both. We're currently working on a cash forecasting project with a fintech at a global corporate level. So, we're open to any and all combinations and permutations. And we also noticed that a lot of our bank partners are working with some leading fintechs in order to drive better solutions, which we really kind of embrace and use where they make sense.
Tobias, what's your
So I just actually want to expand on that, because to use another buzzword, which is kind of the ecosystem, I think we should go beyond just thinking about banks and corporates and possibly also fintechs. But I think whether you like it or not, there are other parts playing into this, like regulation, etc. We talked a lot about also risk management, etc. So, and we've seen a lot of kind of scandals recently also on where you can go terribly wrong. So I think to really drive more innovation, and we've seen also in other industries, sometimes regulatory change is the light switch moment for some real change. So I think to combine all those elements in the ecosystem that are driving this will be key. So, and I think that banks actually can play a big role in this. Philip said, he's focused on his corporate business. Corporates might not be the ones who are kind of connecting all those people on the ecosystem, but I think banks, being a true intermediary, right? So being between different areas, can play that role quite well, as they have direct access to regulators, the direct access to the corporates. They are collaborating with fintechs, so it's one of those opportunities to combine.
Thanks. And there have been some other comments I've noticed on the chat with respect to some of the things we've just been speaking about. So, and I think what I'll do is I'll turn to some of the comments that are coming in from the audience. By the way, if anybody does want to raise a question, I think you can click somewhere on the bottom of the screen on the Q&A, and you can ask questions. So there was one that came in quite earlier on, where we were asked to, and I've got to read from my iPad here, so excuse me for a moment. Any comments on the observed behavior of multinational corporate drawdowns against credit facilities early on in the COVID pandemic, and then leaving the cash on current accounts, typically with larger global banks? Now that sort of plays to some of the things you were saying a bit earlier on, Tobias, about the difficulty that the regional and local banks are in terms of retaining market share, the difficulties that they're having. So firstly, I suppose there's any comments on that observation, which I think we all saw the RCFs being drawn against. And then the second question that naturally comes from that is, well, I'm a regional bank, I'm a local bank, what am I going to do about it? How do I address this?
This is clearly something we have seen, especially during the first lockdown, when most of the corporates across the world and in Europe in particular got scared that at some point they would run out of cash. So yes, we have seen that to some extent, but it was rather limited. Well, I guess that the states have put in place some protection mechanism, which have been quite efficient, at least in most part of Europe. And that's maybe the reason why it has not been the wave that we could have expected at the very beginning. So no, and at the end, it was also, we all have to keep in mind that keeping 100 million euros on open accounts is quite costly those days for the banks, and at some point we have to charge the corporates for that cash. So it's it's hard to find the right balance those days. But again, we haven't seen a big wave coming from this RCF being drawn and cash left on the accounts.
Yeah, and maybe if I just kick in some observations here, I think what came very clear early on in the crisis is that at the end of the day, it wasn't a liquidity crisis. And again, coming back to the ecosystem, the governments and played a big role in this, securing more stability, so that we didn't have the experience we had in the financial crisis 2008-9, where we had obviously a very, very different picture. But it just shows that in this type of crisis, it's more than just 2 or 3 players that have to work together to really kind of counter a tremendous challenge. And I think, Philip, when we had a pre-discussion, you mentioned that, obviously at Unilever, it was less of a challenge, but what we see is it really also depends on the industry. And we've seen that also in terms of bank-firm relationships, banks have reacted differently depending on which industry you're really in.
Yeah, that's true. We were strong single A in a relatively stable conservative sector, consumer goods. We've seen lots of volatility in different categories, different countries, but it all aggregates up to something reasonable when you compare it certainly to other sectors that have been really kind of impacted in a very harsh way. And then, of course, people behave differently according to the situation they're in. We went to the Eurobond market in March last year and issued a 2 billion Eurobond to pre-fund some of the upcoming maturities to be on the safe side, because we could, and we had access to the capital markets. And in a difficult market, we chose to do that rather than to put more strain by calling on standby facilities with banks, because if everyone does that just because they want to feel safe, and that's a problem. And part of the partnership is that you have that dialogue and you don't act in a one-sided way unless you're really in a corner or have to. But yeah, different corporates have been in different experiences and different levels of impact. So I do realize and recognize that life is different depending on where you sit. I was talking to one of my treasury peers in an airline in Europe, and what they were describing was a totally different experience. And I have a lot of sympathy for that. It's when you realize that it's not always so bad to be in a sector like consumer goods, although we have our own challenges, let me say.
So another question here then: how important are investment choices becoming? So I know that traditionally, I suppose it's been money market funds or overnight depots, or maybe a little bit longer than an overnight depot. But in terms of investment choices, is the trend to more choice? Are corporates demanding more choice? Philippe, are you able to deliver more choice?
Well, the blunt answer to that question is yes. Thanks to the fintechs, thanks to the symbiosis that we are creating, thanks to you when it comes to our liquidity management engine, the next generation of our liquidity management engine. So clearly, yes, scarce resources on one side, money, fast innovation, more competitions on the other side. You don't want to be making the wrong choice, that's for sure. But again, the good news is that we have more choices out there, thanks to you, and we clearly benefit from you to be more agile and to make wiser investments. And these co-constructions of solutions together is also something we value very much. We speak every day with our clients. Well, we have a panel actually of 5 large clients that we involved in our for shaping our future engagement management. But it also applies to the work we do together. So we invest wisely. And as I said, we are investing at Société Générale more than ever, but you don't want to be making the wrong investment because of our legacy system. Everything costs a fortune.
Indeed, yes. I think a larger part of any sort of new implementation tends to be the integration. Philip, any comment from you on that question?
Yeah, I was just trying to separate two issues on my mind. So one is investment in becoming more future fit and technology. The other one is when we have surplus cash in the center, how do we invest that? So maybe on the second one, when we're a net debt company, but we do have central surplus cash from time to time, and obviously we'd like to invest that. And yes, choice is helpful. So diversification of choice of how we can invest that cash safely is important. And I'm happy to say that we do have a relationship with Société Générale, and they were one of the first banks actually to come with an innovative green deposit solution back in 2019, if I remember that well. Some people might be surprised to hear. So we're constantly looking for good relevant solutions. So if I look at the other side in terms of what investment choices are we driving, then we're a small centralized team, so we need to be careful where to put our focus of attention, right? And therefore where is the most attractive business case? And I think I mentioned earlier, driving the accuracy in our cash forecasting to improve across kind of the landscape of our ERP setup and the different cash tax payments happening around the world and the different payroll processes around the world, and all of those things that aggregate up into a cash forecast. And by saying cash forecast, I mean more short term, the next week, the next 3 weeks, the next 6 weeks. I'm not talking 3 months, 6 months, 12 months out. But I think this is where technology can also help us to recognize patterns and to help us navigate and make the right choices. So that's an area where we're investing. And I think also it sounds a bit boring, but also making sure the infrastructure is up to scratch. We've upgraded our treasury management system, moved it to the cloud, made it more cyber-proof. And it's a relatively boring activity, updating your treasury management system, but it was bigger than some people might think, and it's important to keep the infrastructure up to date because we also don't want to have any control issues or kind of losing visibility on certain things, and also being able to process the reference rates are changing, all the IBOR changes that are happening, that needs to be reflected in the system landscape. So we also made the adjustments on that front. So it's also important to invest in the existing infrastructure and then keeping it kind of future fit.
Thank you very much. Tobias, any sort of last comments from you? I mean, you shared a wealth of information. Thank you very much for that. It was very insightful, and I'm looking forward to going through it again because, to be honest with you, I think I picked up about 1/10 of it. But please, if there's any other sort of comments that you'd like to make before we wrap up this session.
Yeah, actually, you mentioned a good point, and maybe I was not. I was actually kind of showing how not to do it. Reducing complexity is important. So one thing we picked up when doing some C-suite custom study is that the range of activities the treasury management team and the CFO is now involved in is expanding, and it's way beyond the traditional financing ask that they were focusing on in the past, while teams are shrinking in terms of headcount. So while choice might actually expand, there is little time for those important people to make choice. So you have to, while increasing choice, you have to make sure that handling that increasing number of choice is possible with decreasing number of people and increasing complexity. So I think that's one of the things that we have to kind of keep in mind when we offer new solutions to clients. And I can tell you that switching cost, and even if there's an incremental improvement, clients might not be willing to learn yet another language, so to speak, for an incremental small improvement. And to keep that in mind, so keep it simple is one of the key themes. Again, buzzword, we've heard this kind of before, but it remains true nevertheless.
Yeah, so keeping it simple. Well, I like that idea, and it's a good way to sort of close out. So Wednesdays with iGTB is the title of Intellect Design Arena's regular transaction banking webinar series. And if you've missed any of the previous webinars, go to igtb.com. I'd really like to thank you all. Tobias, Head of Banking at Coalition Greenwich, Philip Sass, Corporate Treasurer at Unilever, and Philippe Benichou, Managing Director and Head of International Payments and Cash Management at Société Générale. Thank you, each of you, for joining this session. Our next Wednesdays with iGTB webinar will be focused on trade finance. So please, everybody, look out for announcements on LinkedIn and for the invitation in your inboxes. And I guess with that, I'd like to thank the audience for participating, for joining, for listening to us. And we look forward to seeing you all on another future webinar. Thank you very much.